Today's discussion is with Vinod Bhat, CFA. Vinod is a portfolio manager and equity strategist at a leading mutual fund company in India. He's the author of a very interesting book called The Financial Independence Marathon. This book is on its way to becoming a bestseller. In my opinion, it is a toolkit rather than a book. It explains how we can get started on our investment journey across the different classes of investment options that we have available to us in this day and age. He demystifies it, he shares it in a very comfortable and easy to approach manner. So, this much wanted goal of becoming financially independent is not just a myth. Vinod teaches us how to break it down into actionable pieces. So tune in and let me know what your thoughts are.
So, right now we are at this stage where at least the Indian markets are tearing, right? It's at an all-time high. So, just your first thoughts, where in this age, when you're reading things of stocks hitting all-time highs and so on, I believe there's a lot of FOMO which is ongoing. So, how much does this construct of sprint versus marathon still apply?
Yeah, I think that's a great first question to start with. And like you said, it's very visible in the data. A couple of months back when the stock markets were not going anywhere, we saw there was a significant decline in the interest from investors, whether it was through, investing in mutual funds or investing directly in stocks or in trading and all that, right? So we saw there was a decline in interest. And now, for the past couple of months, again, we have seen a quick rally in stock markets. And quite naturally, as you said, there's a lot of FOMO, and now we are again seeing a lot of interest coming back. So retail investors are back to trading directly in stocks or in futures and options, or increasing their lump sum investments in mutual funds. And it's clear that again they're thinking this is a quick sprint they can run and make some money, right? But uh, over the historical time periods, if you see, this has happened again and again, and it normally doesn't work out very well, because to really make wealth in the markets, you have to be invested for a long time, and you only make real money when you invest at the bottom, right, and you are able to exit at the top, right? So if you come in at the top, then the chances that you will make real wealth are very low, right? So that's what one has to be careful. So if you come in with a sprint mindset, thinking that the market is doing well, let me come in now and I'll make quick money, most probably it will not work out. If you come in with a mindset that, hey, a business cycle typically lasts for 5 to 7 years, so I need to stay to the complete cycle. And that's how where the marathon mindset comes in, right? Where you know that it's going to take some time. It may take 5 to 7 years. I have to stay invested, and only then that's when you make some real wealth in the markets.
Now, I want to dig back a bit on this marathon analogy, because when I was training for my first marathon, in fact, my first marathon run ever at that time, it was much sunnier than expected. And so when the run started very early, as you know, these races start as early as 5:30, 6 a.m.
Right.
So that time the weather was nice. And I'm like, hey, I've got to sprint, I've got to make the most of it, because later on it's going to be terrible. Meaning the markets were good for me, and I flipped my entire preparation, I flipped my entire process on the fly, and that turned out to be a terrible mistake, because later on when it did, heat up in the temperature wise, my body started breaking down,
Yeah.
and I was not able to finish well. I finished, thankfully, but I know plenty of people who literally had to be walked, and they quit the race and so on. Now, in this kind of a market scenario, where you have people who are invested for a long time, but they might be tempted to break their processes and say, okay, fine, man, it's heating up. Let's act on this tip. Let's act on this suggestion, make some money. How does one prevent themselves from doing that?
Yeah. So you brought out a very good point about thinking about this in a form of an analogy with running a marathon, which I have also done in the book. And the reason I've done that is because, see, when you run a marathon, right, it's not just about being at the start line and then running 10 kilometers or 21 or 42, right? There's a lot of preparation involved before you reach the start line, right? So whether it's in the form of a diet, whether it's in the form of training where you run, let's say 5 kilometers, 7 kilometers, 10 kilometers, whatever, right? And you prepare, right? And after that you come to the start line and then you start running. Right now I usually run the full marathon, 42 kilometers, and the way I train, the way I run the marathon is always as a run walk, right? So it might be that I run 9 minutes, walk 1 minute, or run 4 minutes, walk 1 minute, and so on, right? So uh, that's a strategy I use that has worked out very well for me, and it's the same strategy, a similar strategy I use in the markets, right? So what it means is that when I'm investing, I'm using the principle of asset allocation, where I'm investing in stocks or equities, I'm investing in fixed income or debt, which includes FDs. I'm investing in commodities like gold and silver and so on, right? And the way it works is, for example, now if let's say the stock markets have rallied, right? So one way to think about it is, hey, let me just exit and wait for a better time to come again, right? But it's very difficult to time, right? We may exit now, but the market might continue to go higher, right? You never know. So then what should we do? So just like using a run walk strategy in the marathon, what we need to do here is maybe reduce our equity exposure a little bit and shift that to either to commodities like gold and silver or to debt, right? And let's say if there is any correction in the market, stock markets, then again you increase the equity exposure. That's the same strategy like you're running for 9 minutes, then you want to take some rest, so you walk for 1 minute, and then after you got that rest, again you start running, right? So this principle of asset allocation is what one needs to keep in mind in investing. So we are never out of the market. We are only reallocating or rebalancing between different asset classes depending on the level of the market. So that's what I would suggest to the viewers and listeners, that instead of trying to time the markets, think in terms of asset allocation and rebalancing.
Understood. So I think this is wonderful because even when I was preparing for my running days back then, I started off with a mode where I was running non-stop. Like let's say if I was training for 10 kilometers, my run would start a bit slow, but then I would hit after the first kilometer, I would hit my comfortable running pace and would maintain that throughout until the end. And that did not scale well. That did not scale well for me for say a 21-kilometer run.
Correct.
And then eventually I also landed up on this run walk approach, and I figured out even over there, like my rhythm would vary depending on, let's say, the time of the year or how much preparation I gave time to. So I think that is the investment rhythm, I would say, or the running rhythm. Now,
Correct.
similarly, you may have an investment rhythm as well. Now, for running, it's easy to determine for yourself because how you're feeling, you can do that pulse check. You can say, okay, I'm running too fast. My heart rate's increasing more than I'd like to. And then you can make the adjustment. How does one think of an investment rhythm like that?
Yeah, see, again, you hit the right point, because when we are running the marathon, normally, people who are not accustomed to it, or who have started running, they think it's just about running the fastest pace possible, right? But once you have run for some time, you realize that it's more about maintaining, your heart rate. It's more about focusing on your breathing, and then whatever pace you're comfortable with, that is the pace at which you run, so that you can sustain it, right? So it's the same thing in investing. So the way I think about it is, first of all, you know, you need some money or some savings to invest, right? So that's a starting point where when we get some income, typically we think income minus our expenses is equal to our savings, which we can invest, right? But the right way to think about it is income minus investments is equal to your expenses. So what I mean is, if my monthly income is 100 rupees, then right at the outset, I save 10, 15, 20 rupees and only spend the remaining 80 rupees, right? And out of that 10, 15, 20 rupees I have saved, then I decide how much I should invest. So I always have some savings or some money that I can invest every month. That is step number one, right? Step number two is what we call the SIP, or systematic investment plan, right? Now, what it means is that every month out of your savings, you need to invest money. It might either be in mutual funds, it might be in direct stocks, or in any other asset class that you're comfortable with based on your asset allocation strategy. But you need to invest every month, right? And that is called the systematic investment plan. The third thing is, like I said, depending on the level of the market, deciding your asset allocation. So you should always be clear in which asset class you should be overweight or underweight, right? And like I mentioned, the simplest way to do it is to think about equities, fixed income, and commodities, right? And for people like you and me who might be doing their jobs or who might be running a business, it becomes very difficult to keep track of everything that's going on in the market. So mutual funds become the easiest route, right? And you have different types. You have, equity mutual funds, you have fixed income mutual funds, you have hybrid mutual funds. Now you have index funds and ETFs, right? So you can invest in them, get exposure to different asset classes, and keep on rebalancing your exposure to the asset classes, right? So this is how you build up your investment rhythm in terms of, if every month you save some money out of which you can invest some portion. Second, you follow your systematic investment plan so that every month you're making some investment. And third, you're following your asset allocation and rebalancing strategy. This is the same way, like we mentioned, like you track your heart rate, you focus on your breathing, and then you run at a sustainable pace while running.
Okay, that makes a lot of sense, Vinod. And here, particularly for this book, since you talk of financial independence, like apart from the rhythm, what also matters is a target. Like, am I running a 42-kilometer race? Am I running a 100-kilometer race? And often you see the person who's completing a half suddenly sets sight on the full marathon. The full marathon aspires to become an ultra runner, and ultra runner aspires to, do even crazier stuff.
Right.
And I have not found anyone who says that this is one number and one fixed number only which I need to hit. That number keeps on changing.
Correct.
Because you're like, okay, I need something today based on some lifestyle which I'm living now, but there's lifestyle inflation. Then once you start adding like a retirement corpus, like most of these calculators, they make it easy to say, okay, this is how much you need to save to hit a certain target number. But while you're doing that exercise, what I find is you start throwing in really crazy things. You start saying that, okay, fine, I need, say, some funds for kids' education. But then you're like, okay, kids' education where?
Right.
In India, in US, and again, where? Like at the top tier schools, at really private schools, and so on. And then you make it even worse. You're like, oh, maybe, something for their wedding expense. But how much? You want like a simple wedding now, or you're thinking, no, 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 a big bang wedding. So I have not found a simple way to say this is a target corpus. Like, what is your suggestion? Like, how should
Yeah.
one say that this is a minimum number you should shoot for?
Right. So, see, in my experience, what has worked uh, more is having a goal rather than a specific number. I'll give you an example. When my daughter was starting her first standard, and this is 12 years ago almost, right? So that time I thought, okay, I'll start doing a SIP in mutual funds for her education, right? And I started investing 10,000 rupees a month in the form of SIPs in mutual funds, right? And I've done that consistently, right? So that is like, I'm investing 1.2 lakhs in a year, which in 12 years is about, let's say, 15 lakhs, right? Uh, and now she's just completed a 12th standard, right? So I saw what that corpus has become. It's become a reasonable number because on average, when you're investing for about 10 to 12 years in the stock markets through mutual funds, normally you will make around 12 to 13% per year, kind of a return, right? So given that context, like, it's a respectable number. Now what I realized is just the fact that I was saving for my daughter's education helped me maintain that discipline, right? So I never had second thoughts whether I should put in that 10,000 rupees or not. So irrespective of whether the market was at a high or at a low, whatever it is, I didn't care. I just kept on investing the 10,000 rupees, and it has become some X amount of corpus at the end of 12 years, right? So that is one thing that has helped because I never thought of, okay, I want to save X amount for her education. I just thought I'll save, right? And that gave me the motivation to save. Now the other thing though that I want to point out is, again, what has worked in my case, like I said, when I get my salary, right, I, in my mind, I keep 20% minimum aside that I want to invest, right? And it might be more, right? So it depends. But and I've been, just because I'm in this space, I'm in the investment space, I'm very comfortable about it. So I've been investing that money. Now it might be for education, it might be for my daughter's marriage, it might be for for my home, loan, EMI payments, or it might be for my retirement, right? So I haven't really made different buckets like that, but what I have done is maintain that discipline that out of my monthly income, I'm investing X amount before I think about my expenses, right? And just doing that again has helped me to build a reasonably good corpus, right? So I realize what you're saying, because even I have tried out those calculators, and they come back with some scary numbers, which ends up demotivating most of us, right? So rather than doing that, what, like I mentioned, what has worked for me is just a simple principle that out of my monthly income, how much ever, the maximum amount I can save and invest, I try to do that. And if I do that consistently, if I just be disciplined about it, then over 10, 15, 20 years, I'm reasonably confident that I'll have a good corpus that I can then decide what to do with.
And I like your approach of shooting for goals and say that, hey, here's a goal I'm going to shoot for, and this is what I can comfortably allocate.
Right.
And whenever that duration is reached, the end of that, you're like, okay, fine, I can pay for that particular expense out of this corpus, whether it's more or less, then you make the adjustment, but that drives your decision making. You're never shooting for the stars or the moons. You're never comparing that, hey, I only got so much. Like, hey,
Correct.
this is what I can do at this point of time, and whatever we get is what we'll spend.
Yeah, and just for reference, see, a lot of studies have been done on historical data, and it's like the way the markets work, investing works is, if you just focus on short term, right, like 1 years, 3 years, 5 years, it's difficult to say what kind of a return you will get, right? But if you remain invested for any time frame more than 10 to 12 years, right, then typically, right, if you have done things right, if you have just followed a normal asset allocation strategy, you will make around 12 to 13% per year kind of returns, right? So that means that you'll kind of, you're doubling your money every 6 years, right? But that is a number you can keep in mind, that I'm just going to invest as much as I can. I'm going to be disciplined. I'm going to follow a simple asset allocation strategy, and if I remain invested for 10, 15, 20 years, then I can expect a 12 to 13% per year kind of a return on average. And that's kind of, I can calculate what kind of corpus I can end up with, right? So that's a simple framework to keep in mind. And over time, as we grow in our roles in our job, or as a business grows, of course we can allocate more and more to our investments, and the corpus size also grows.
And I think that's where I want to turn how to best use your book. Because what
Sure.
I like about your book, I made a lot of these dog-eared marks, like you used to do in the olden days. So what I like about your book is you very simply break down the different kinds of assets that you can invest in, and also the assets that you need to be careful about, like the latest trends like Bitcoin or NFTs, which were a rage 2 years ago. If you're caught up in that, maybe you made some money in that short amount of time, but quite likely, that those investments have not panned out as people have thought them to be. Who knows how they can turn out? I have no idea how they would work as an investment. But the point is, in your book, you break down a lot of assets, a lot of methodologies that one can adopt. What is the best way to use your book?
Yeah, so I wrote this book with my own family in mind, because see, although I am in the investment profession, I realize my family members are quite risk averse. Like many of them have put their money only in FDs, right? And for them, investment always has been a big risk, almost like stock market is like a gambling or a casino for them, so they have stayed away. I've tried to educate them, but sometimes I realized, using financial jargon doesn't work. So that was a motivation for me to write this book. So I written this as a very simple and entertaining and actionable guide. And that's why I've written it in the form of a story or a novel that one can read easily. It's entertaining, and through that format, I've tried to explain the basic principles of financial planning, what we talked about, or how to think of asset allocation, risk before return, and the basics of different asset classes. Now, whether it's stocks, whether it's equity and debt mutual funds or hybrid mutual funds, or going forward passive funds, ETFs. And like you mentioned, some of the more exotic asset classes that have come up, whether it's Bitcoin, NFTs, or investing in startups. So how to first of all, as an investor, how to make oneself aware that these are the investment options we have, right? So that is step number one. At least you should know these are the different asset classes we can invest in. Second is you should be aware of the risk return trade off of each of these asset classes, right? So each of them falls somewhere in the risk return spectrum. So we should know where each of them falls, right? And on that basis, we can decide what our asset allocation should be, right? And then third is to know, how to rebalance between these asset classes. Like, should I be investing more in equities, or more in fixed income at this time, or look at commodities like gold and silver, right? So there has to be some framework based on which we can take these decisions, right? And that was the idea behind writing the book, that my own family members could learn about basic principles of financial planning, asset allocation, could know the basics of different asset classes, and have a framework for decision making they could use, so that instead of just keeping their money in FDs and being very risk averse, at least they could act and have a good framework in mind to take decisions. So that's how I would recommend the viewers and listeners to consider my book as a very simple, entertaining, and actionable guide which can help them to take investment decisions.
And in my opinion, I think this book really is a toolkit. So I don't think this is just a one-time read. It is something that you can read once, make sure your strategy is set, and then every now and then, like maybe it's a quarterly basis, you pull it out again and figure out, okay, am I sticking to something? Is there something which I've missed out on? So thank you, Vinod, for this one.
Sure.
And there's also another reason why I think people are more risk averse. Uh, One is the concept of FOMO. The other is also with the amount of options which are available to invest in these days. It creates an overwhelm. What complicates things also are people showing you their portfolio numbers, or rather these screenshots that you see circulated on WhatsApp and Twitter and wherever. And I think when you look at those kind of screenshots, it shakes you up internally. Like, am I doing something wrong? And you're like, hey, my score is nothing, man. And look at these people. They have the portfolios, like the runs that Tendulkar and Virat Kohli are scoring.
Yeah.
So how does one again maintain sanity as well as like an asset allocation, uh, particularly when it comes to comparing portfolios?
Yeah. So, I am part of a running group here in Mumbai, and like you said, there are people at all levels in my running group, right? So there are some folks who have just joined and are starting training. In my case, I have been running for almost 13 years. I have run quite a few full marathons also. But then there are other folks in my running group who recently, ran the Comrades Marathon, which is like a 90-kilometer race in South Africa, and came back, and they have run it in less than 10 hours and stuff, right? So naturally, if I look at their achievements and compare myself, I would think, hey, I'm nothing, man. I've been running more than 12, 13 years, and still I can just run 42 kilometers, right? Uh, but then obviously you and me know that approach just doesn't work, right? I mean, it's not the right way to think about it. There's no reason for me to compare myself to them. That is one. Second thing, also in my experience, when I started running full marathons, I remember my first full marathon. After about 25, 26 kilometers, you start feeling tired, and I started getting cramps, and I recovered, and I was slowly making my way forward. And I could see a lot of women, and girls passing me by. And at first I thought, hey, well, come on, yeah, even women are running faster than me. Like, what's this? And so that those thoughts used to come in my mind, right? And then, but over time, I realized, when you're running a marathon, you are only running your own race, right? So all you worry about after, let's say, 32, 33 kilometers, you're only focusing on the finish line and reaching that finish line, right? Because by that time, you are so tired, both mentally and physically, that nobody else matters to you anymore, right? Your mind is just focusing on, hey, man, I just want to reach that finish line, right? So that's how things progress. So I realized that, in my next marathon, my entire focus after 32 kilometers is going to be reaching that 42.2 kilometer finish line, right? So I stopped worrying about other people around me. That was the first realization, that I'm running my own race. But then over the years, the other thing I figured out is, forget about the race. Right now, like you mentioned in the beginning, all I focus on is, my heart rate and my breathing and what is my sustainable pace and following my run walk strategy, right? And I've realized that if I do that properly, then I enjoy the marathon really, right? And if I don't do that properly, then I end up feeling miserable. Like even if I finish the marathon, I don't feel good, right? Whereas if I do everything right, the basics, then I really enjoy the marathon, and the timing doesn't matter. It doesn't matter, who crossed me, or like, which position I came in. Those things nobody cares about, and it doesn't matter to a runner also, right? So just focus on the basics and just think about your goals right now in our life. I realized, what is important for me. It was okay, saving for my daughter's education, or it might be for a marriage, or it might be for the down payment for my home, it might be for my retirement. As long as I'm meeting those goals, it doesn't matter to me what others are doing, how big their corpus is, right? And this realization comes over time, right? You and me both know, like once we go through life at different stages, our maturity levels are different. And once you reach a certain point, just like, when you reach 32, 33 kilometers in a marathon, you realize, hey man, nothing else matters, right? It's just you and your race, and you have to reach the finish line. It's the same thing. Once you reach a certain point in life, you realize nothing else matters. Basically, whatever goals you have, and you just have to reach those goals.
I agree, and what you say applies to other walks of life, including our careers as well.
Yes.
Because when I started running for long distances, and the first r- race or running group you're a part of, you people overwhelm you with the tools that they have. There'll be people who run with that high-end shoe. You're like, hey man, that shoe costs $500, and when you're running with, let's say, a $50 or $100 shoe, like
Right.
man, these people are at a whole different level. Then some people will have like, how they have these grenade belts that they show in military. They'll
Yeah.
have those kind of belts with different rings and different gels coming out. I'm like, I have nothing. What do I do? But then once you hit your rhythm, that's what matters. How you feel, and your pace, your comfort level. That's the only thing in your control. But it's hard to tune off that distraction. I think that's the biggest time. Like getting that, getting to that stage where you're like, what the others do are not mattering.
Exactly. And at least for me, I mean, just going back to the marathon analogy, just what works is just focusing on my breathing, right? If I do that right, then just everything else kind of, you zone out of everything else, right? And that's the same thing in when it comes to investing, right? So if you focus on the basic principles of asset allocation, rebalancing, you will take the right decisions. If you get distracted by what others are doing, or like get in either in FOMO or in panic, then you'll end up taking the wrong decisions. So just have a simple basic framework in mind, and run your financial independence marathon.
So that's an interesting segue because you're talking of, let's say, distractions and newer asset classes. And when we are young, we are more to be enamored by these things. And in your various tools, I see you in different parts of India. You are interacting with a lot of youngsters, a lot of readers of your book, and I see a lot of youth that is in your pictures. So, what is the financial mindset of young India?
Yeah. So, I have been pleasantly surprised, and sometimes shocked also in terms of the discussions I've had, because, as a part of my job, I do a lot of sessions with investors and, mutual fund distributors, financial advisors, and so on across the country. And especially in 2020, 21, when there was a craze about Bitcoin, NFTs, and so on, like, I used to go and talk of basic principles of financial planning and asset allocation, investing in mutual funds. And after my sessions, invariably, youngsters used to come and tell me, hey, that's all great, but like, we have invested in Bitcoin, like, what's your view on Bitcoin, right? But then last year, like since 22, when there was a crash in Bitcoins, NFTs, that craze has died down. And I've had, elderly people coming to me and saying, hey, are like, my son or my daughter, they had invested in Bitcoin, and they're sitting on big losses. What we should do now, right? That's one kind of experience I've had. The second, on the other side, has been more pleasant, where some youngsters have come and told me, hey, we have already started investing in mutual funds. Like, one of the guys I met was a store manager in a bookstore at Crossroad Bookstore. So he told me that, he has been doing an SIP in mutual funds with a goal of making a down payment on a home he wants to buy, right? And I mean, I was so happy to hear that, like, because that was what have talked about in the book, and here was this person who is already implementing it, right? Or so same thing, another store manager at Mumbai International Airport, at the books etc. store. He also told me that he has been doing an SIP in investing in mutual funds, and so these kinds of experiences really kind of motivate you in terms of, okay, I need to go out and spread this message more, like, and make sure that more and more people understand this. And it's not just that I want to educate my own family members. It's that, okay, everybody in the society should know about this, they should benefit from it, and kind of take the right decisions, right? So I'm pleasantly surprised youngsters are much more aware. And just to tell you, like, my daughter just started her FIBA, and under this new education policy now, they had an elective course called financial planning and literacy, right? So, and I saw the syllabus, and it was very good. Yeah, like, they're talking of different asset classes, and they're going to introduce them to the stock markets and investing, right? And I've told my daughter that I'll open a brokerage account for her and start
Wow.
an SIP and all that, right? So I wish when we were younger, when we had started our college, all of this was there. But I think things are changing for the better.
I'm very happy to hear this, and I do see a lot of young folks as well in my work. A lot of them are from startups, but I guess there is a lot of financial literacy that they are aware of.
Yeah.
So even when they are getting involved in a lot of these speculative assets, it is a conscious decision. So in their mind, it is that, yeah, I know I'm taking on a very huge risk. It may not pay off, but this mindset is very different than someone who's like, hey, I'm just itna paisa laga dena hai.
Correct.
Dekhte kya hota hai, no? Which is like a very much a gambling mindset. Here they're like, it's a speculative asset. It could work, it could not work. So I
Right.
think even that tiny change augurs well for them.
Yes. So definitely, like, given there's so much information and content on social media, and all the youngsters are on social media, they are much more aware than what we were. But also there is information overload, right? And they may not be referring to the right sources. So taking the right decision sometimes may become difficult for them. But like you said, I'm just happy that at least they're aware that these investment options are there, and they're not just being risk averse and keeping their money in FDs like everybody earlier used to do, right? So that's the positive part.
Vinod, thank you so much for having this discussion with me today. I think you've demystified a lot of things, and I think the way you break down the approach, both in this conversation today as well as in your book, I think it's a very actionable, approach that you are outlining, and it reflects in the way both you speak as well as the way you write. So I request people who have tuned into this, wherever you are, pick up this book, The Financial Independence Marathon, Unlock the Power of Your Money. You can find it on your favorite bookstores. You can find it online. You can read soft copies. It's a reference book in my opinion. It's not a one-time read. It's not a popcorn book, but it's a very light read, for a serious topic. So I think that's a lot of credit for that goes to Vinod and to his team, of editors who made sure that the tone is fun and conversational. So thanks much, Vinod, for joining and for penning this book.
Sure. Yeah. Thanks, Hemant. I appreciate you having me on this session, and I'm glad that you found the book useful. And I hope that all the viewers, listeners will also find this book to be helpful in their financial independence marathon. Good luck.